Thankfully, there isn't a lot of big macroeconomic news due in the coming week, as there's an absolute deluge of updates due from British corporations. The big feature top down, well, that's probably going to be the second estimate for first quarter UK GDP growth. Remember that the initial figure was for a fairly measly 0.3% quarter-on-quarter increase, although that did mean the year-on-year growth rate was 2.1%, higher than the Bank of England and the Office for Budget Responsibility predicting for 2017 as a whole. If you do want to look in greater detail at this number, please bear in mind two things. First, there's a third estimate that follows this second one, so the figures could easily be revised again. And second, it's a backward-looking number, and financial markets are forward-looking discounting mechanisms, so from a strictly investment point of view, I'm not sure how valuable or useful it is for all of the acres of press comment the number's going to generate. So, moving very swiftly on, let's get on to the bottom-up stuff, where there should be some very timely and informative commentary. Key numbers to watch from FTSE 100 firms include full year results from Water Utility Severn Trent on Tuesday the 23rd, final results from FTSE 100 newbie Mediclinic and support services giant Babcock, as well as a trading update from B&Q owner Kingfisher on Wednesday the 24th, and full year figures from United Utilities on Thursday the 25th. There's also a bundle of results and updates due from FTSE 250 members as well, but for me the stock most likely to cause a fuss in the week ahead is Marks & Spencer, when the High Street Bellwether reports full year numbers on Wednesday the 24th of May. This is a big set of numbers for Chief Executive Steve Rowe as they cover his first year in charge, and it's been a testing one too, at least if the share price is any guide. Over the past 12 months, shares in M&S are down 13%, making it the sixth worst performer in the FTSE 100, although as we can see here, there's been a bit of a recovery of late. In fairness to Mr. Rowe, the whole retail sector's having a pretty tough time of it. Next is one of the 5 stocks to have done even worse than M&S over the past 12 months within the FTSE 100. In addition, Rowe is trying to make major changes. The new boss is looking to close or rationalise overseas operations, prune back top-heavy management teams at headquarters, cut pricing points, overhaul clothing ranges, de-emphasise sub-brands, open new food stores and close underperforming sites. That's quite a long list, and Steve Rowe isn't finished yet. After the year end, he's appointed a new chairman of the board, retail heavy hitter Archie Norman, and also a new head of clothing, health and beauty, namely the current Halfords boss Jill McDonald. She's a particularly big job, as it's been clothing that's been M&S's weakness for several years now, and improved trading here is vital if the shares are to make further headway. When it comes to the numbers, that's where everyone will start. Like-for-like sales growth at clothing, then food, and then the UK overall. This next chart shows the quarterly year-on-year trend back to 2011. The third quarter figure released in January at least offered grounds for hope. Food rose 0.6% year-on-year, clothing and home 2.3%, taking UK sales 1.3% higher on a like-for-like basis. The clothing improvement ended a run of 6 straight drops and was actually the unit's best quarterly showing since Christmas 2010. Now, a little bit of caution. First, like-for-like sales growth at clothing and home was negative 5.8% year-on-year in the same quarter a year ago and negative 5.8% the year before that, so the base for comparison was soft. Second, Steve Rowe did flag the uncertain consumer outlook and began to get his excuses in early for the fourth and final quarter of the financial year when he flagged possible adverse impact from the timing of discount sales and also a later Easter. So maybe the improvement won't carry through, but watch the like-for-like sales trend. After that, analysts will head straight to the pre-tax profit number, where the consensus figure is £593 million. That forecast compares to £489 million a year ago, but don't forget that was depressed by £200 million in restructuring costs, so the real underlying base for comparison is £690 million. Note also that analysts think pre-tax income will come in broadly flat over the next 2 years, so check out the outlook statement as well. Finally, assess the dividend. An unchanged full-year dividend of 18.7p would equate to a yield of around 5%, but earnings cover is only 1.5 times, thinner than ideal, so watch the cash flow. Net debt ended the last financial year at £2.1 billion, and it would be nice to see that come down as well. Lower debt means lower risk, after all. Thank you for watching, and I look forward to seeing you next time.